What's up you guys, Joe here from the Average Joe Investor channel where we help the average Joe become financially independent. The great news is here in 2021 there are so many different ways for anybody to become financially independent. You can do it through real estate if you want to. You can start your own business and you can also invest your money in the stock markets, specifically dividend stocks, even growth stocks, index funds, and the topic of today's video, which is options. We previously talked about the basic core concepts when it comes to options and calls and puts. And in today's video, we're going to talk about a strategy I think, need to really avoid, and that is buying options. Specifically in this video, we're going to talk first about why do people even buy options at all? Because there are definitely some surface benefits that people want to take advantage of, yet they end up losing money along the way. We're going to look at an options contract inside of Robinhood, a great beginner platform for options traders. We're going to break down what an options value is derived from. We're going to talk about the differences between extrinsic value and intrinsic value. We're going to talk about time decay and how it is always working against option buyers. We're going to break down the 3 huge problems that are affecting options buyers. And make sure to stick around all the way to the end of the video because I'm going to share with you some common objections that many options buyers that would say that they're successful would argue against what I've talked about in this video, and we'll break down what would need to happen in order for them to be successful. You guys know I never want to waste your time, and I always want to deliver massive value with every video that I make. So without further delay, let's get started. All right, jumping right into it here, why do people even buy call options? There's a very clear answer here, and that answer is leverage. You can of course always go out and buy 100 shares of a stock, whatever it is, but there is a benefit that can be derived from purchasing a call option. All right, I pulled this screenshot off of Robinhood so we can write on it. A few things to point out here. First off, current share price here is $175.07. All of these numbers right here, 180 call, 177.5 call, 175 call, these are all of the strike prices. And then over here, this number is the premium that would be required to be paid by the option buyer, which is then paid to the option seller. And then up here we have our option expiration date. So this means that the option expires on January 14th. Now you can always go out and purchase 100 shares of Apple, but as you can see to the right here, $175 per share times 100 shares equals a total cost of $17,500. And when you purchase 100 shares, you get to participate in unlimited upside, but you also have to participate in unlimited downside. And in theory, you could lose all of your money. Now we can contrast that with one call option. Remember that premium is quoted in per share, but every contract is for 100 shares. So when you take any premium here, $1.36 for the 180 call, and we multiply by 100 to get the total cost of $136. Now I'm no mathematician, but it's certainly a lot cheaper to purchase one call option at $136 than it is to control 100 shares by purchasing all of them at $17,500. Additionally, you only are putting up, from a risk standpoint, $136, but you get 100% participation on the upside as long as the upside is above $180 for the call. Making sure we're on the same page here, a call option, when you are purchasing one, as a buyer, you have the right, but no requirement, to purchase 100 shares at the strike price on or before the expiration date. So coming back to our screenshot here, as the price is $175 per share currently, if you are purchasing the $180 call right here, that is giving you as the option buyer the right, but no obligation, to purchase 100 shares of Apple at $180 on or before January 14th. And for that right, you are paying $136. Now, you would only really do this, you would only purchase shares at $180 if the shares were above $180. If the shares were $177 per share, then you would just purchase shares at $177 rather than paying $180. You would go out in the open market and actually pay for these shares yourself. However, if the price of Apple is now $190 and you have the ability to pay $180, well, that's a great benefit to have. So we have massive leverage here if we can guess the price direction correctly, and we also have limited risk at $136, the cost to buy the option. Let's talk a little bit about how the options value is derived. It's critical to understand this part. So an options value at any time can be derived into 2 specific values. Its extrinsic value and its intrinsic value. An option's intrinsic value is what it's worth right now, today. And you can derive that by looking at the stock price and subtracting the strike price of the option. Going back to our example we just looked at, the current stock price is $175, and the current strike price of the option is $180, which means that we have no intrinsic value. It has no worth right now. The strike price is higher than the share price. And if we know that the option's value is $1.36, that was what we paid for it, then we can determine that the extrinsic value, what it could be worth in the future, is valued currently at $1.36 because its intrinsic value is 0. Our extrinsic value is what could potentially be in the future based on two important characteristics: time and volatility in the stock. When I say time, I mean we've got 9 days until expiration. Who knows what's going to happen with the share price during those 9 days? And volatility could occur, right? The stock could surge up due to news related to Apple, or the overall market could go way down or way higher, and that volatility in the stock price could lead to changes in the extrinsic value as well. But with 9 days to go and potential for volatility, that value is $1.36. That is why the option value is $1.36. So what's the problem with purchasing a call option, especially when we're talking about an out-of-the-money option, meaning that it has no value right now, the strike price is higher than the share price? The problem is every option has time decay. We know that the extrinsic value is partly derived from time. And if we're looking at this chart, we can see that we've got the value of the option on the y-axis, and then we have the time to expiration down here on the x-axis with 30 days left, hypothetically. With 30 days left, if you were purchasing a 30-day option, the time value is super high because we've got 30 days for who knows what can happen. However, as you can see over time on this graph, all the way down to 0 days left, the time slowly is worth less. And you'll also notice that as we get closer to expiration, that the time decays faster and faster and faster until it's really shooting down here in the last few days. So there are inherently 3 big problems with purchasing call options or put options. We're talking about purchasing options. It just makes, I think, more sense logically for our brains as a newbie to think about call options and trying to bet on the stock going up in value. First issue here is we have to get the price direction correctly. If the stock is currently $175 and we think it's going to go to at least $180 per share and the stock price stays flat, doesn't do anything, or it goes down, we lose as an option buyer. It has to go in the direction we think it's going to go. Secondly, you have to get the timing correctly. Not only do you have to get the price direction going up correct, we have to do so in the time frame allotted. We know that the stock price needs to go to 180 from 175, but it's got to do it in 9 days. And then third, the price and the timing need to be correct, and they need to be correct by enough to offset the cost of the option. Remember, to control 100 shares of Apple, we had to pay money to do so. So if the price is currently 175 and our strike price is 180, remember that we also paid $1.36 per share in order to control 100 shares. So not only do we need to reach 180 in the time frame, we need to actually go beyond $181.36, which is the strike price plus the cost of the option, in order for our option to make money. So if we're holding our option all the way to expiration, more on that in a second, the price of the stock just can't meander its way here like this and then stop at, 180. That's not going to be good enough for us. We need it to exceed 181.36 for us to make money. This is the start of our profit right here. So 2 big takeaways here before we talk about some objections. The first is call options that are out of the money, right? A price that is higher than the current share price, are cheap. And they're cheap for a reason. The big reason here is that most of the time these options expire worthless. They're just not going to reach that strike price in order for them to be exercised and add any value to you. And remember that when you are an option buyer, every single waking hour that passes in the day and every day that passes, time is working against you. Your option is worth less and less every day because there's less time available for that value to go up. Now, most option buyers who would say that they're successful would argue a few points here. The first they would say is, I'm not holding my option to expiration. I plan on closing it for a profit. So how would this look? What would this actually look like? Let's remember here, looking at the chart, that the current price when we bought the option, it was valued at $1.36. That's what we paid for it. And remember that we would need it to go above 181.36 if we were holding it to expiration for the option to have any value at the end for us. But what could happen, and this is I think what most option buyers are banking on it, is they're banking on the price going up, but not going up eventually, but going up rapidly right away. Something like this. So let's say it's right here, 179. And it makes this move from 175 to 179, and it does it in 2 days, which means we have 7 left. So we still have a lot of time left, and the volatility has shot up really high. We are very close to our strike price. When this happens, your option likely would have gone from 136 to, I don't know, we'll say $2.90. Well, at that point, you could continue to hold in the hopes that Apple will skyrocket to 185, 190, 195 by expiration, and we could collect that huge profit, or you could take your profits now. Remember, when we bought this option, we bought it to open our position. So at some point along the way, if we want to close our position, we would sell it to close. If we wanted to sell our option here after 2 days, we would take that 290, which is our selling price, and we would subtract what we paid for it, $1.36. The difference here would be $1.54 per share, but remember, the contract is for 100 shares, which would lead to a profit of $154 per option contract. And to figure out our return here, we would take that 154 divided by what we put up to do the option, 136, and that would lead to a 113% profit. Remember though, what needs to happen for an option buyer to be successful is they have to get the price direction correct, they have to get the timing correct, and they need it to happen fast in order for their option value to go up by so much, for it to be worthwhile for them. Now, they could always purchase a longer term option, let's say 14 days, 30 days, 45 days, and when you do that, you certainly have some more time in the first week or two for that option value to go up and the time value to not go down by as much. But remember, at the end of the day, you still need to get the price correctly, and you need to do it quickly and in the time frame allowed. This is why most people who buy options don't make money. I much prefer to sell options because the odds are ever in your favor. In a future video, we're going to talk more about what selling options looks like, why it's a benefit to you, why you act as like the casino, and we always know that the casino always wins. We'll also talk in the future about my favorite option selling strategies and how you as the average Joe can be successful as well. Make sure to leave your 2 cents down in the comments below. Let me know what you thought about this video. Did you find it helpful? Did you learn something new? What other topics do you want to see me cover here on this channel? Make sure to leave your 2 cents down in the comments below. That's all I got for you guys in this video. Have a great rest of your day, and please continue to stay healthy, both physically and financially. Have a good one.